Welcome to This Explainer. So, you know that feeling when you look at a company's financial records and it honestly feels like you're trying to decode some ancient, indecipherable language? All those debits, credits, ledgers, it can seem incredibly intimidating. But what if I told you that the whole foundation of modern business isn't actually a complicated math problem at all? It's really just a simple, relatable story of universal balance. Today, we're going to break down these seemingly complex accounting rules and translate them into everyday concepts that just make sense. Okay, let's take a quick look at our roadmap. We'll start with the magic of balance, then explore the three types of accounts: personal, real, and nominal. And finally, we'll wrap up with exactly why this balance matters so much. All right, section 1, the magic of balance. Now, before we look at a single number, we really have to understand that a business is a lot like a physical ecosystem in nature. Nothing just appears out of thin air, right? And nothing vanishes without a trace. Energy simply changes form. While in business, money and value operate the exact same way. And this brings us to the double entry system. The absolutely crucial point here is that whenever money or value transfers, we have to track both sides of the trade to maintain harmony. You literally cannot have a giver without a receiver. Think of a business transaction exactly like a playground seesaw. For every single interaction, someone or something receives a benefit. So that's one side going up. And someone or something gives it up. That's the other side going down. To keep our financial ecosystem perfectly mapped out, we have to document both the receiving aspect and the giving aspect every single time. Now, if you're running a business, you're interacting with a ton of different things, right? Customers, suppliers, physical equipment, digital services. To keep this seesaw perfectly balanced without losing our minds, all transactions are neatly sorted into three distinct buckets. We've got personal accounts for people, real accounts for property and assets, and nominal accounts for incomes and expenses. And the best part? Each bucket has just one simple golden rule. Moving on to section 2, personal accounts, people interactions. Let's see how this works with financial favors between real people. The official rule for personal accounts is actually just common sense for basic human interactions: debit the receiver and credit the giver. If you think about doing a favor for a friend, the dynamic is exactly the same. Let's look at a real business scenario to see this in action. Say we receive cash from a person named Ajay. Let's call it 1,000 rupees. In our ecosystem, Ajay is the one providing the value. Since Ajay gives our business 1,000 rupees, he's the giver, tipping the scale. So to accurately record where that value came from, we apply our golden rule: credit the giver. We must credit his personal account to restore the balance. Makes sense, right? Now let's flip the scenario entirely. If we hand 5,000 rupees to a supplier, let's say Ramesh and Company, the flow of value changes direction. Ramesh and Company receives the benefit from us. Because they are the receiver of the value, our rule tells us exactly what to do: debit the receiver. So Ramesh and Company gets the debit. It is wonderfully straightforward when you frame it around just giving and receiving. So that perfectly covers human interactions and the flow of value between people. But a business isn't just people, is it? What happens when we introduce objects into the mix? How do we maintain our ecosystem's balance when tangible, physical stuff is involved? That brings us to section 3, real accounts, physical stuff. When we're dealing with physical property and assets, the rule becomes incredibly visual. Debit what comes in and credit what goes out. Imagine drawing a giant, literal chalk boundary line around your business. You simply debit whatever physically crosses that line to enter your business, and you credit whatever crosses that line to leave it. For example, imagine you're running a factory and you purchase some brand new machinery for 50,000 rupees in cash. If we apply our visual boundary rule, the physical machine crosses into your business, it comes in, so it gets a debit of 50,000. At the exact same time, your physical cash leaves that boundary, it goes out into the world, so it gets a credit of 50,000. The machine comes in for a debit, your cash leaves the ecosystem for an equal credit. Boom, the seesaw stays perfectly level.
Next up, section 4, nominal accounts, the invisibles. Okay, so what happens when we treat invisible things? Things like experiences, services, or actions. For nominal accounts, we have to balance invisible forces. The rule here is debit expenses and losses, and credit incomes and gains. I know this one trips a lot of people up, but here's the trick. When you incur an expense, your business is actually receiving the invisible benefit of that service. You're the receiver of the benefit, so it's a debit. When you earn an income, your business has given some invisible effort out to the world, so it's a credit.
Let's look at rent as an example. If you pay 1,000 rupees for your office space, what's actually happening? Well, the business receives the invisible benefit of getting to use that physical space for the month. That's an expense. The benefit is coming to you, so it's debited. Meanwhile, the cash physically going out is credited based on our real account rule from earlier. And let's look at the other side of that invisible coin: income. If you earn 400 rupees as a commission for facilitating a sale, how does the balance work? Well, cash physically comes into your business, so that real account gets a debit. But what did you do to get it? You gave out the invisible action of earning that income. And because you gave that invisible benefit, the commission income account gets the credit. Which brings us to our final section, Section 5, Why Balance Matters. Having seen the mechanics of people, physical stuff, and those invisible actions, let's zoom out a bit. Look at how elegantly all of this synthesizes together. Whether you're dealing with a person, a piece of equipment, or an invisible service, every single give in our ecosystem requires a perfectly equal take. There are literally no loose ends in this universe. And that leads us to the ultimate law here. Every debit must have a corresponding credit of an equal amount. This isn't just a suggestion. It's the unrelenting gravity that holds the entire financial universe together. Without this fundamental law of the double entry system, the reality of a business's finances would just be completely broken. It would be this chaotic place where money mysteriously appears and disappears without a trace. The business would be like a seesaw permanently stuck in the dirt, entirely unable to function or be trusted. This perfect balance is what makes truth in business possible. Which brings us to a really fascinating final thought. If every financial action requires an equal and opposite reaction, what does your own personal ledger look like? I'll leave you to ponder this as we wrap up our explainer today. If this strict, unrelenting law of universal balance is required to keep a simple business healthy and truthful, how balanced are the giving and receiving aspects of your own daily life? Thanks so much for joining me for this explainer, and keep seeking that balance.